Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown, but this time from the road.
Yeah, I will. Happy Thanksgiving week to you. Hope things are going well.
Yep. So far, so good.
Are you in Missouri or in Ohio?
So I'm in Ohio now, but I'll be in Missouri around 11 or midnight tonight. So
Okay, so you're on the road too.
yep. Just hopefully
Safe
the traffic is
travels.
terrible. Yeah, thank you.
I'll let you know if there's any traffic between there and here.
Yep. So where are you headed to right now?
So I'm on my way back to Missouri from Ohio as well. I'm in Richmond, Indiana.
Okay.
So I'm en route.
En route. So looking at talking of en route, what kind of route have the market's been in the last week or so?
Yeah, so for December corn up 2 cents to 6.59. January soybeans, which that should be noted as a change of contract from our November contract we've been working with, down 4 cents to 14.36. Soybean oil for December down 3.3 of a cent to 7.30 or 73 cents per pound. Soybean meal down $4 or up $4.50 per ton to 4.11. And then old crop wheat for December down 19 cents to 7.99. New crop July wheat down 23 cents to 8.31. And then that West Texas intermediate crude oil down almost $5 to fall below $80 per barrel for January.
Gotcha. And so some losses there. What really kind of led the market on its way down there?
After 6 straight weeks of increasing U.S. ethanol production, output fell last week below 300 million gallons. Weekly gasoline usage also pulled back 3% on the week. Last week's National Oilseed Processors Association October crush report showed that their members collectively crushed 184.5 million bushels of soybeans during the month, right on the dot with pre-report trade expectations. U.S. ag export sales were relatively strong. That's the first time we've said that, I think, this marketing year. For corn and soybeans, soybean sales were especially strong in the second largest volume on record. Open interest, futures, and options positions of Chicago wheat and Chicago soybeans were marginally up on the week, while corn saw a 4% decrease in open interest positions. Managed money position holders sold out of net positions of corn in a big way, down 60,000 positions, while soybean market saw a little marginal sell-off at 11,000 positions. The UN, Ukraine, and Russia grain corridor was extended for another 120 days starting November 18th without any changes to the current agreement. Last week's U.S. cattle on feed report showed all U.S. cattle on feed as November 1st at 11.7 million head, or 98% of last year's volume. The nation's second largest railroad worker union narrowly rejected the agreement that prevented a national railroad strike 2 months ago. Without an agreed deal, portions of that railroad agreement will end and railroads can start striking on December 8th. U.S. weekly export inspections were up week over week for corn, soybeans, grain, sorghum, and wheat. And then some of the U.S. ag export sales were held coming on the heels of a weakening U.S. dollar index, which traded its lowest level since August last week.
So definitely nothing going on in the markets at all last week. Seems pretty tame now.
It was a busy week, actually. As I was reading through that, I was like, gee whiz.
But well, and really, I want to start off. You talk about all those corn contracts that were sold off, and then a lot of losses on the wheat front. Does that really relate back to the corridor in the Black Sea? Getting extended.
Yeah, it could. I think the majority of it is just this general tightness or general risk-off attitude we have towards the end of the calendar year. It tends to start right here at Thanksgiving break and goes through all the way to the end of the calendar year before resuming in January. So we're seeing funds liquidate prior to the end of the calendar year there. Plus, we're just seeing some low volumes in the market. So I don't want that to take away from the fact that these markets are still headline driven in some ways. Reactions could be somewhat headline driven as a reaction to the UN grain corridor as well. But we're just talking about some generally lower volumes here towards as we round out the last couple of weeks of the year.
Yeah, well, and taking that a step further, looking at general supply chain factors, it's always not always, but the last several months, it's felt like you take one step forward, take another step back. So the UN grain corridor, some positives there, and then some negatives on the rail side here domestically. What do you expect that to have an impact on? How great of an impact do you think that'll have?
So I'm pausing here just a little bit to actually think about what I think is realistic here. I tend to remain in this camp that we're going to have a lot of political posturing up until the deadline here, December 8th. But I do believe that we're going to have some type of agreement that's going to prevent the railroads from shutting down. So I think a lot of this, while very much should be taken in all seriousness, and certainly as we get closer, we might start seeing some products stop moving for a short period of time. But I do anticipate that we will have some type of agreement by the time December 8th rolls around.
Yeah, and I'd assume that these two things I'm about to talk about are pretty separate, but we're in the holiday season, so there's a lot more shipping traffic in general. Is that going to further slow down ag products with other things being shipped as well, or are those pretty much independent of one another?
We see some competition. Certainly there is competition. I think it's helpful to remember that we're shipping different products, right? So and it gets shipped in different ways. So most of what we buy is coming for Christmas is coming via containers. We ship most of our commodities out via bulk containers or bulk shipments. So really shipping out of two different measures. They compete in some ways, but really, not really the same type of chain.
Yep, that seems to be what you might expect there. So anyway, and really one of the biggest things that I think has been trending, especially this month, has been watching the value of the US dollar finally start to trend back downward. Ever since January, it was at a low of around 94, the US dollar index in January, and then ticked all the way up to 114 in September. But now we're seeing things kind of maybe calm down a little bit. What's the reasoning behind that? How does that really work?
So I think part of this is the market really wanting U.S. inflation to slow down, really, really, really wanting it to ease, mostly from the standpoint of easing inflationary pressure. And again, not deflation. I want to make that clear. We're still increasing, but not at the same rate, right? We're increasing at a decreasing rate, to use a fancy economist term. But the market really wants to see some easing there, so the Federal Reserve stops increasing interest rates, that short-term federal funds rate. And so here in November, we got some decent economic inflationary data at the beginning of the month that I think really encouraged the market that, hey, things are trending in a better direction. Maybe the Federal Reserve stops increasing interest rates. And that really spilled over into the US dollar, helped kind of decrease that dollar valuation compared to other currencies around the world. So that certainly helped.
I almost compare it to two vehicles on the interstate. The one in the left lane. Hopefully it's the left lane. You're supposed to pass in the left lane. It bugs the heck out of me when people don't do that. Anyway, when two vehicles are on the interstate and the one on the left lane is passing the other, but then the one on the right starts speeding up just a little bit. So the one on the left is still going faster, but that distance between the two is slowing down. That distance, I guess.
Yeah. That's kind of what we're seeing here. Like, we're still increasing almost 8% on an annualized basis for many of our core commodity, the basket of current commodities that we track. But it's still increasing. It's still year over year increasing, but that rate of gain is slowing, and so that's giving market watchers some optimism that the Federal Reserve will slow down. We'll see if that happens.
So I guess really looking forward, is it going to depend, the U.S. dollar index, heavily on what the Fed does and how they handle the next several months? It's very hard to, I guess, predict exactly what's going to happen. But do you see the current trend of the slowdown in growth continuing?
So, good question. So it's helpful to remember that the U.S. dollar index is our currency relative to a basket of other currencies. Certainly, not all currencies have depreciated the same amount relative to the U.S. Dollar, and so as we see, some of those heavier weights, the currencies that get a heavier weight within the dollar index, start to change or strengthen, right? Like, that could encourage some weakness within our dollar. It's hard to say, and I'm not going to sit here and predict that we're going to continue to see some weaker dollar moving forward. I certainly think that the softness that we have seen here over the last few weeks, and really over the last week or two, or at least here since the beginning of the month, since this turn of November, but that weakness, I think, has really been both a signal that the market is expecting the U.S. inflation to really start to tamper, while other countries work to increase the strength of their dollar through different policy measures and fiscal policy. So
And I feel
monetary
like
policy in other countries. Yep.
I might have put the cart in front of the horse here a little bit. I feel like early on I should have asked you this, but can you describe what those numbers mean? So let's say you have a number of 110. What does that represent when it comes to the U.S. dollar?
Again, this is all relative to a basket of other currencies. So it means different things depending on what you're talking about. The only way to think about this is it is relative to our US dollar in a period of time. That's all it means. It's how strong is our dollar relative to other currencies on a period of time comparable to a previous time, right? So 110 is stronger than 90, and that's all we can say. We can't depict anything else out of that.
You can't take an actual value difference between the two.
Again, it's going to be different depending on which currency you're talking about.
So
it's just an index of relative. It's relative to the U.S. dollar at a different time.
Fair enough. Fair enough. So recently we've seen some positive news on the U.S. export front. Do you think that's somewhat tied to watching the currency adjustments, or are there key or other factors that have been key within that?
Yeah, no, we've seen as the U.S. dollar has dipped, we've seen some stronger sales by international buyers. Again, our product's getting cheaper, all else equal, compared to other products or other competition sources around the globe. So I think that's opened up some possibility to get some more product moving, at least some more product on the books. The one concern I do have here, I think, as I look out ahead, is there's rumors that Argentina is going to renew or put out a renewed pesos for soybeans program. Again, that was something they used earlier this fall to bring Argentina soybeans to the market at a very almost highly subsidized rate. They're talking about an even higher value. So that's probably the one thing that does concern me quite a bit, is if Argentina does that again here over the next month, then that really starts eating into our export window that we've kind of owned for the last 10-15 years. Here at the end of the calendar year, even January and February, we really own that export window. And so Argentina is starting to encroach in that. Brazil will come on at some point and really dominate that market next spring. So this is really eating into our market share if that were to come around again.
Well, and two, it seemed like this year, I guess, pause momentum got off to a slow start as well. So, you're kind of losing a little bit of time on both sides of that.
Absolutely.
All right. So looking forward to the rest of this holiday week, what should farmers really be paying attention to watch that could move the market?
Yeah, it's an odd week with the Thanksgiving holiday on Thursday. So ethanol report coming out on Wednesday, and then everything else is kind of on a different timeline. So I'm just going to end with, we've got an energy report coming out Wednesday, and we'll pick it up again next week.
All right, Ben, it's always a pleasure. Thank you for joining us from the road. Get that pumpkin spice latte for us, and have a good trip back to Missouri.
Thanks, Will. Have a good week. Happy Thanksgiving.
Right. Viewers, listeners, if you'd like to learn more, you can do so at brownfieldagnews.com. Also, check out our sister program, the Weekly Livestock Market Update. Thank you so much. I'm Will Robinson on Brownfield.